Here's gold. We know we came down to this lower trend line of support right around 4,100. We got that huge bounce the last few days. Yesterday, we saw the dollar rallying. We know that when the dollar rallies, the price of gold generally declines. The dollar's strong again today. So we're really seeing a pullback. And very clearly, you have a high, low, lower, low. So we've been in a shorter term downtrend on gold. I still don't see a bottom yet on gold. I still think it's going lower as it's generally trading with risk assets minus the dollar power. But right now, yeah, I remain on the sidelines. I have a few, obviously I have my core holdings in gold. I'm a big believer in gold, even in Bitcoin. But for the most part, I'm not buying yet additional gold yet at this level.
As you can see, what I've pulled up is a daily chart of a continuous futures contract of gold. You can see that on Thursday of last week, on the 11th of June, we actually touched the bottom of this green line, $4,045. That was short-lived, though. As you can see, after hitting this all-time record high up here, that came in, of course, at the end of January. We hit a series of lower lows, the first one, the second one, and then the breakthrough here, the third one. I've got green arrows showing that they were support in this area. You can see the red arrow signifying that I believe it's currently resistance. The other thing that we want to look at is I have two moving averages up. The green moving average, which is my shorter term 50-day, and the longer term 200-day. You can see as they widened, that's when we were really seeing a huge move. And realize by the nature of using moving averages, they lag greatly behind real-time data, especially a 200-day and a 50-day. But you can see how these have narrowed tremendously. Narrowed where the 200-day and the 50-day is coming closer. If it actually would cross, that would be a significant level of chart damage, but we're not quite there yet. My sense is that I believe that around $4,000 will be a floor in gold, and it's simply based upon the low that we saw last week. And if we carry that back, you can see that this was also an area of support. We could move it back a little bit further, and then if it did slip lower, that would be the next level. But right now, there's some data, not exceedingly strong data, that suggests on a technical basis, because of this bottom here, that this could be the floor. My assumption right now is it's going to be, and later on I'll explain why I believe that to be in terms of fundamental events. The key right now, David, more than anything else, is the acknowledgement, and this is from the World Gold Council, that the biggest purchasers of gold this year that are going to be actively accumulating gold are the central banks. I forget the actual numbers, but according to one article, they said that they interviewed a lot of the central banks, and the survey found that 57% of the respondents are now switching gold from where it's being located for safety reasons, but they're active buyers. The central banks are believed to accumulate vast amounts of gold over the next year. And that's according to a survey by the World Gold Council to all of the central banks. Yeah. And so the central banks are large purchasers of gold. That's not like retail investment. It's not even like hedge fund investment. When central banks are buying and they're converting their fiat into that hard asset, one, that tells me that they're losing faith in whether they're overseas working with euros, whether they're in China working with yuan, regardless of their local currency or the currency that's a primary currency in the central bank. The fact that it is such a high percentage of central banks that responded saying we're going to be actively buying and adding gold to our positions, to me, that is significant. That's the most significant thing that I believe, if anything has the opportunity to move gold back into the positive. And when I say the positive, once again, I'm just looking at the chart and I'm talking about it moving back above $4,000, which was a low that we hit, $4,045 last week. And that's basis of futures contract, not spot. It depends on your goals. Now, I can tell you for me, I have been very slowly accumulating physical gold, holding it in a safety deposit box. As it got really over about 3,500, I slowed down to whereas I put that on pause because I didn't know how high it would go. And, it was at 3,500. And when that was an all-time record high, you're not certain it's going to go to 5,500. If I would have known then what I know now, I would have continued to buy. Now I believe that people that have taken the advice of many advisors, including myself, which is that all portfolios should have 10 to 15% of their assets in something like gold or silver, physical gold or silver. If you've been following that rule, you've already got some kind of a stockpile. So at this level, you want to add much slower than you would typically accumulate, but you still want to accumulate because we know we now have a really hard ceiling above 5,500. That's where the record high is. You can buy it right now for under 4,100. I'm sorry, 4,350. That's how fast it's moved off of this. So my recommendation for those that have been actively accumulating, you want to continue to do it at a slower pace. For those that are just considering that, let's say you've gotten out of college, you've worked for a couple of years, and now you're trying to decide how you allocate into stocks, bonds, and things like gold or silver. You still want to look at 10 to 15% as a max, but at this level, you might only want to put 7 or 8% right now until you see it back up on a strong upswing. You certainly don't want to liquidate, at least in my opinion, because when you're buying physical, it's a it's a decade kind of investment. When I buy something like that, it's probably going to go to my kids. I'm not looking to do anything with it. Luckily, I've never had to liquidate it. So I will continue to accumulate, but at a much slower pace. For those that are just getting started, rather than looking to allocate 10 or 15%, initially try to allocate 5%. And if it does move down to different levels, so let's say, for example, it did break below 4,065, my next major level of technical support is about 3,900. You'd want to allocate more there, dollar cost average on the way down. If it breaks below there, on a technical basis, the next level doesn't come into about 3,400. But I say that with one huge caveat, and that is fundamental events rule. That's what moves the price of gold, not the number on a chart. I see silver moving to a different tune, a different drummer, any way you want to say it. There's been a tremendous disconnect to a degree. And the degree I mean is typically you will see gold and silver move in terms of the direction in the same direction. Gold and silver tend to move up when there's bullish market sentiment for the precious metals and down when there's bearish market sentiment. The one thing that to me stands out, this red line that we're looking at is the 200-day moving average. And you can see that on last Thursday, the 11th day of June, it actually moved into it. And then on Friday, yesterday, and today, its price point has remained above the 200-day. We've seen the narrowing between the 50 and 100. But the key is, if you recall from the gold chart showed that gold was well below the 200-day moving average. Silver is not. So in that way, it's been more sensitive, but yet it has shown a more bullish inclination because, again, as a market technician, if silver's above its 200-day moving average on a long-term basis, it's bullish. If it's below, it's bearish. So if we use that as kind of a benchmark, and the 50-day is a short term, of course, then silver is back in a long-term bullish scenario. And when we look at it, and I can compress this to a degree where you'll see, here's the last time silver dipped under this was in April of 2025. Look at how these two lines widen. Look at the width that came between in the middle of March this year, and realize that during that time, you had this tremendous sell-off. You then had a lower high, lower high, lower high, low, lower low, lower low. Whenever you've got a series of lower highs and lower lows, by definition, that there's selling pressure because you're going to get higher highs and higher lows in the market moving higher. So we're not out of the woods yet, but there's a ray of hope in the fact that silver has come up, whereas gold has not. And so, to me, when I see something like this, as I continue to accumulate, I'm going to look to accumulate silver rather than gold, or if I'm doing both, more silver than gold in terms of dollar investments. And that's what I've been doing. Since recently, I've been purchasing small amounts of silver, and I've kind of held off on purchasing gold. If inflation, which is at 4.2%, moves down to 2.5%, it's close to their 2% target. At 2%, they probably would consider cutting rates. But as long as you have inflation elevated, and when I say elevated, it's relative. I've lived through Clinton era periods where we had 15% inflation. I mean, I've seen inflation. Anyone that's 50 or older has seen real inflation. Not to make this a non-starter or an important point that it's at 4%, but relative to where we have been and where we are, inflation has become extremely elevated. The key is when you look at the Fed's dual mandate, maximum employment and inflation around 2%. If employment stays strong, but inflation continues to grow, they work